Everyone. Thank you for joining us again today at the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president. I'm always proud to host events here with distinguished friends and officials, and sometimes people who are both friends and officials. But I am particularly proud to be hosting today, co-hosting actually, with the Bentheim Center for Finance at Princeton and my friend and colleague Marcus Brunnermeier. We are at the cutting edge, I guess, by having some of the world's leading central bankers and leading monetary thinkers come to speak about money, the future of money in the digital age. And of course, we're also joined by a rock star in the form of Martin Wolf. We are delighted to be doing this, particularly obviously this week, when so many senior officials and people in markets are in town, and we're grateful to our friends who've joined us today. In particular, I want to thank Frank Brosens, of Taconic Finance, who is a member of our board of directors and a member of, I want to make sure I get the title right, the advisory panel, I believe it is, of the Advisory Council of the Bentheim Center for Finance, one of the most brilliant real minds in finance. I'm grateful to Frank, not because he just has such excellent taste in institutions, but because he gave the nudge to Marcus and I to actually come together. And so in many ways, we always talked, but we hadn't come to anything. And so we're grateful to Frank, which gave fruition to this. We are starting on a more timely schedule than usual, partly because it's this week and partly because we are grateful and proud to once again welcome back Lael Brainard, a member of the Board of Governors of the Federal Reserve System, to the stage here at the Peterson Institute. This is the point with this crowd on this topic where Governor Brainard needs no introduction. She has been a member of the Board of Governors of the Fed since June of 2014. She previously served as Undersecretary of the U.S. Department of Treasury from 2010 to 2013 and counselor to the Secretary of the Treasury in 2009. In short, she has been the leading U.S. official on matters of international finance from both the Treasury and the Federal Reserve side of the street for many years now, shown extraordinary leadership during the crisis, during issues of G7 and G20 management. I always cite her incredible work in getting the currency piece, which we have enjoyed since late 2012, which I think her leadership played an enormous role in. And obviously in recent years, as part of her work and public service at the Federal Reserve Board, has been a leading light on innovation and regulation and the growth effects of finance. And we are very honored to have her with us today. I will invite her to speak in just a moment, just to say again that this is a jam-packed, full, substantive event. We not only have Governor Brainard, and then we'll be taking questions from Marcus and I, and then from the floor to her as her schedule allows. Then we'll be turning to a new paper presented by Professor Brunnermeier, co-authored with Harold James of Princeton, who I'm glad to see is with us today, and Jean-Pierre Landau of Sciences Po, on how digitalization will transform the role of money. We have available for everyone on the website and in print this new paper, The Digitalization of Money by Brunnermeier, James, Landau. We also have a number of short pieces written by the usual 1,000 flowers of thought at the Peterson Institute that I encourage you also to read. Finally, we will have a superstar panel moderated by Martin Wolf, the chief economics commentator and editor at the Financial Times, with Governor Stefan Ingves of the Riksbank, which is on the cutting edge of these technologies, Simon Potter of the Peterson Institute, now formerly of the New York Federal Reserve, who we're delighted to have with us, and probably the most brilliant mind in finance I know, even allowing for Marcus, Hyun-Sung Shin from the Bank for International Settlements. So this is a spectacular group. Thank you all for joining us, and may I invite Governor Brainard to the stage.
Well, thank you to Adam for a very kind introduction, and it's always a pleasure to be here at Peterson. There's a long history of technological advances challenging the prevailing notions of money, from the trading of coins to the use of paper currency to the electronic debiting and crediting of funds on the accounts of banks. Today, efforts by stablecoin networks such as Facebook's Libra to establish the next chapter in the story of money are raising threshold questions about legal and regulatory safeguards, financial stability, and monetary policy. Because of its potential global reach, Facebook's Libra imparts urgency to the debate over what form money can take, who or what can issue it, and how payments can be recorded and settled. A decade ago, Bitcoin was heralded as a new kind of digital currency that would provide the three functions of money without the need for centralized governance. Bitcoin's emergence created an entirely new payment instrument and asset class, exchanged over a set of payment rails supported by distributed ledger technology, a shared, tamper-resistant ledger that can be updated by anyone with sufficient compute power. But Bitcoin did not achieve widespread acceptance as a means of payment or unit of account due to its extreme volatility as well as limited throughput, unpredictable transactions costs, limited to no governance, and limited transparency. Stablecoins were designed specifically to overcome the volatility of the first-generation cryptocurrencies that limited their utility in payments and as a unit of account. As their name is intended to convey, stablecoins aim to maintain stable value by tying the digital currency to an asset or a basket of assets, such as commercial bank deposits or government-issued bonds. Unlike first-generation cryptocurrencies, they may be issued by a central entity and rely on third-party institutions for some aspects. Just as any currency's value as a medium of exchange increases with the size of the network using it, so too the power of a stablecoin payment system depends on its ability to achieve widespread adoption. In light of the 2.7 billion active monthly users on Facebook's platforms, the Libra stablecoin project stands out for the speed with which its network could reach global scale in payments. To provide context for assessing stablecoins, it's useful to understand established arrangements for the issuance, regulation, and transfer of money. Central bank money and commercial bank money are the foundations of the modern financial system. Central bank money, physical cash, and money held in deposits at a central bank represents a safe settlement asset, allowing users to exchange central bank liabilities with confidence in their acceptance and reliability. In addition, central banks play a critical role as providers of liquidity at times of stress by lending central bank money. Money held in deposits at commercial banks is widely used because people are confident that they can convert it on demand for the liability of another commercial bank or the central bank, such as physical cash. This is because bank deposits are insured, and commercial banks are subject to supervision, regulation, and deposit insurance requirements. Non-bank private money or assets can also facilitate transactions among a network of users. In some cases, such as airline miles, such assets may have value only within that network. In other cases, the issuer may guarantee convertibility to a sovereign currency such that it becomes a liability of the issuer. In those cases, customers trust that the company issuing such money will be able to honor those liabilities. Many U.S. consumers experience non-bank private money already in the form of gift cards, loyalty points, and virtual gaming currencies. For instance, Starbucks reported it had $1.6 billion in stored value card liabilities towards the end of last year, which is more than the deposits of many banks. As the scale and scope of such private networks grow, so too do the convenience and benefit of transacting within the network. These network benefits may be augmented by the active use of network data for a host of purposes, from allocating and pricing credit to sharing reviews to prioritizing information that is pushed to users. In China, consumers and businesses participate in two mobile networks, Alipay and WeChat Pay, which by some accounts handled more than 37 trillion in mobile payments last year. These networks operate within China based on the RMB as the unit of account, and balances are transferable in and out of bank or credit card accounts. Stablecoins may represent private non-bank liabilities depending on their design and claim structure. They aspire to achieve the functions of traditional money without relying on confidence in an issuer, such as a central bank, to stand behind the money. Indeed, for some potential stablecoins, a close assessment suggests users may have no rights with respect to the underlying assets or the system overall. We've already seen the growth of massive payments networks on existing digital platforms such as Alibaba and WeChat, and the issuance of stablecoins on a smaller scale, such as Tether, Gemini, and Paxos. What sets Facebook's Libra apart is the combination of an active user network representing more than a third of the global population with the issuance of a private digital currency opaquely tied to a basket of sovereign currencies. It should be no surprise that Facebook's Libra is attracting a high level of scrutiny from lawmakers and authorities. Libra, like any global stablecoin project, must address a core set of legal and regulatory challenges before it can facilitate a first payment. Let me touch on a few of these. First, compliance with Know Your Customer regulations are essential if stablecoins are not to be used for illegal activities and illicit finance. Libra's business model is inherently cross-border, and as such, each participant in the system that is a financial institution would need to ensure compliance with each jurisdiction's anti-money laundering laws. Libra's intended global reach would likely necessitate a consistent global anti-money laundering framework in order to reduce the risk of illicit transactions. Second, issuers of stablecoins designed to facilitate consumer payments must clearly demonstrate how consumers would be protected. Consumers will need to be educated on how their rights differ with respect to digital wallets compared with bank accounts. Statutory and regulatory protections on bank accounts mean that consumers can reasonably expect their deposits to be insured up to a limit, fraudulent transactions to be the liability of the bank, transfers to be available within specified periods, and clear standardized disclosures about account fees and interest payments. Not only is it not clear whether comparable protections would be in place in a stablecoin network such as Libra or what recourse consumers would have, but it isn't even clear how much price risk consumers will face since they don't appear to have rights to the underlying assets. The large number of cyber breaches in the last few years highlight the importance of getting clarity on what legal entity can be held responsible for the security of personally identifiable information and transaction data, and how personal data will be stored, accessed, and used. Third, it'll be necessary to define the financial activities the various players in the ecosystem are conducting in order for jurisdictions to assess whether existing regulatory and enforcement mechanisms are adequate. Switzerland is the legal domicile of the Libra associations. In Switzerland, there are 3 new categories to facilitate their approach of regulating by function. Payment tokens are cryptocurrencies that are meant for use in payments or value transfers. Utility tokens are blockchain-based applications, and asset tokens are crypto assets that are analogous to equities, bonds, and derivatives. Here in the U.S., regulators are closely examining particular stablecoins and cryptocurrencies to determine whether and where they fit in the regulatory structure and whether additional authorities or guidance is necessary. Our market regulators have authorities for products judged to be securities or commodity futures under relevant law. At the state level, the New York State Department of Financial Services has established a BIT license for virtual currencies. The Federal Reserve and the other federal banking agencies have supervisory authority over banks, but the Federal Reserve does not have plenary authority over payment systems operating in the U.S. The FSOC does have the authority to designate systemically important non-bank financial companies, financial market utilities, or payment, clearing, and settlement activities based on the facts of the specific situation. It isn't clear at this time whether any cryptocurrency issuer would meet the statutory requirements for FSOC designation. Fourth, the distributed ledger technology underlying many stablecoins and cryptocurrencies more generally have advantages, but they also have risks. While they could offer advantages by enhancing operational resilience, increasing transparency, and simplifying record keeping, the public and immutable nature of the transactions ledger also introduces risks, such as data privacy concerns and legal complexity. Fifth, widespread mitigation to one or more global stablecoin networks could disintermediate banks. If consumers and businesses reduce their deposits at commercial banks in favor of stablecoins held in digital wallets, this could shrink bank sources of stable funding as well as their visibility into transactions data and thereby hinder their ability to provide credit to businesses and households. That said, many banks are likely to adapt by offering alternative methods of peer-to-peer settlement and by incorporating stablecoins into their business models, whether by partnering with fintech firms who are issuing stablecoins or by issuing their own, as some are already doing. Sixth, widespread adoption of stablecoins could have implications for the role of central banks and for monetary policy. Large-scale migration into a new stablecoin network for purposes of payments may prove to be the leading edge of a broader migration that encompasses the other functions of money. If a large share of domestic households and businesses migrate to a global stablecoin, not only as a means of payment, but also as a store of value, this could shrink demand for physical cash and affect the size of the central bank's balance sheet and the central bank's approach to implementing monetary policy. These effects are likely to be more significant for small open economies or those with weak monetary institutions, where the migration away from the sovereign currency to a global stablecoin could weaken the scope for independent monetary policy through a process that's the digital analog of dollarization. Large-scale stablecoin use could also affect larger advanced economies with extensive connections to the global financial system by increasing market volatility and transmitting shocks across borders. And finally, a stablecoin network with global reach raises financial stability considerations. If not managed effectively, liquidity, credit, market, or operational risks, alone or in combination, could trigger a loss of confidence and run behavior. This could be exacerbated by a lack of clarity about the management of reserves and the rights and responsibilities of various market participants in the network. The risks and spillovers could be amplified by potential ambiguity surrounding the ability of official authorities to provide oversight, backstop liquidity, and collaborate across borders. Even before the advent of stablecoins in some jurisdictions, a pronounced migration from cash to digital payments had already prompted central banks to explore the merits and risks of moving to digital issuance of their own currencies. The potential for global stablecoin systems has intensified the interest in central bank digital currencies. Proponents argue that central bank digital currencies would be a safer alternative to privately issued stablecoins because they'd be a direct liability of the central bank. And you're going to hear later today from Marcus Brunnemeyer about his paper, which provides important arguments in this arena. Of course, the Federal Reserve and other central banks already provide money digitally in the form of central bank deposits in traditional reserve or settlement accounts. However, in the current context, central bank digital currency typically refers to a new type of central bank liability that could be held directly by households and businesses without the involvement of a commercial bank intermediary. Such central bank digital currencies could differ from traditional reserves along three dimensions. A much broader set of institutions and individuals could access it. Some types of balances might not pay interest, and it might entail greater government visibility into end users or consumers' transactions. In the United States, there are compelling advantages to the system that we have today. First, physical cash in circulation for the US dollar continues to rise, suggesting there's robust demand. Second, the dollar is an important reserve currency globally, and maintaining public trust in our currency is paramount. Third, we have a robust and diverse banking system that meets the needs of consumers. And finally, we have a widely available and expanding variety of digital payment options that build on the existing institutional framework and the applicable safeguards. Central bank digital currency for general purpose use, that is for individual consumer use, would raise profound legal, policy, and operational questions. Let's consider the balance between privacy and guarding against illicit activity. If it's designed to provide safeguards against illicit activity, a central bank digital currency for consumer use could conceivably require the central bank to keep a running record of all payments data using the digital currency, a stark difference from cash. A system in which individual payments information would be recorded by a government entity would mark a dramatic shift. A related question is whether the Federal Reserve even has the authority to issue currency in digital form and, if necessary, to establish digital wallets for the public. There could also be profound monetary implications. Some economists have argued, probably in this room, that a central bank digital currency could address the problems posed by the zero lower bound by transmitting monetary policy directly to the public. Executing monetary policy in such a manner could imply the elimination of all physical cash and the power to impose a negative rate or a tax on households' holdings of digital money. Those represent dramatic changes. My own strong preference is to address the effective lower bound by using our existing toolkit vigorously, since I view the cost-benefit assessment of negative rates as unattractive for the current U.S. context. Financial stability considerations are also important. The ability to convert commercial bank deposits into central bank digital currency with a simple swipe surely has the potential to be a run accelerant. And finally, there could be operational risks to a central bank digital currency. For starters, this might require the Federal Reserve to develop the operating capacity to access or manage individual accounts which could number in the hundreds of millions. A myriad of other operational challenges would need to be addressed, including electronic counterfeiting and cyber risks. That said, some jurisdictions may move in this direction faster than others based on the particular attributes of their payments and currency systems. At the Federal Reserve, we will continue to analyze the potential benefits and costs of central bank digital currencies and look forward to learning from our colleagues. While prudence cautions against rushing into untested approaches to central bank digital currencies, we are actively investing in our payments infrastructure so that everyone has access to real-time payments. We announced that we'll launch the first new payment system in more than 40 years to help make real-time payments available to everyone. FedNow will provide a platform for consumers and businesses to send and receive payments immediately and securely 24 hours a day, 7 days a week, 365 days a year. It will provide a platform that's neutral for private sector innovation in new, faster payment services for end users. And we're also exploring enhancements to FedWire Fund Service and National Settlement Services, including expanding office operating hours. As the public and private sectors work to reduce payments frictions, one of the most important use cases is for cross-border payments, such as remittances. Technology enables e-commerce to transcend national borders, but current cross-border payment solutions are slow, cumbersome, and opaque. Authorities in many jurisdictions, including the U.S., recognize the importance of cooperating across borders with each other and the private sector to address these considerable cross-border frictions. No doubt technology will continue driving rapid change in the way we make payments and the concept of money. The Federal Reserve remains confident in the power of technology and innovation to transform the financial system and reduce frictions while also preserving the important consumer protections, data privacy and security, financial stability, and monetary policy transmission mechanisms that have built up over many decades. Given the stakes, global stablecoin networks should be expected to meet a high threshold of legal and regulatory safeguards before launching operations. We are monitoring new technologies closely with respect to the implications for our operational responsibilities and broader public policy goals, and we are open to exploring new possibilities. We're upgrading our services to support innovation and payments, and we will continue to work to foster a safe and efficient payment system, including where money in all its myriad forms, present and future, is concerned. Thank you.
What?
Either way, which do you prefer?
Why don't you stand?
if you will. Governor Brainerd has kindly consented to take questions on the record. I'll play traffic cop if needed, but I'd like to recognize Professor Brunnermeyer to make the first comment or question as he chooses.
I just have one question quickly. So I was struck actually by Starbucks. You mentioned the example that they have 1.6 billion in terms of liabilities to customers in terms of credit cards, or in terms of gift cards. If Starbucks were to decide to liquefy these liabilities, what requirements, do you have any idea when the Fed would step in, or how would it intervene? At one point, would it intervene by saying, okay, you can freely transfer this cash you have for Starbucks liabilities from one customer to the next customer, you pay with your friends and all this. Would the Fed be concerned at this dimension as well?
So I think in the particular case, it's a closed network. And it's really the liabilities of a particular legal entity to a network of users that have signed up for it. So in that sense, it's more like a prepaid card, and we do actually have pretty good, as of recently, even better guardrails around prepaid cards. But that's conceptually how I would think about it. That's the closest analog.
Just the quick ground rules. When you're recognized, please feel free to speak. The more your comment resembles a question, the longer you can go, and vice versa. Please identify yourself when speaking, since the governor's on the record, so should you be. There is a traveling mic, which Patricia will bring you. There's a standing mic in back.
I would just amend that to say, feel free to filibuster.
Oh. Not something I expected her to say. Always surprising. Actually, next in line, though, is Martin Wolf.
So Martin Wolf from the Financial Times. I have two questions, very simple, I think, but not perhaps to answer. The first is, in the US case, how far do you think you need changes in law governing the regulatory structure to actually manage all the problems you indicate with these new players? And the second thing is, in particular, do you have the powers to determine whether specific organizations making radical proposals for a transformation of the system, let's say Facebook, is actually a suitable organization to do any of this? Because some of us think that's a pretty big issue.
So those are good questions. I laid out a little bit earlier the regulatory authorities that we do have across different regulatory bodies in the U.S., and the way that they are currently configured and the extent to which they may be applicable, or they may be potentially insufficiently broad in some cases. And licensing authority in particular, our authority at the Fed is quite narrow. We really have oversight over certain supervised banks. As I said earlier, we do not have plenary authority over payment systems, which I think is a very important point. FSOC authority is a question mark because it is going to depend on the very specific facts and circumstances, and it's really with regard to financial institutions, financial activities. So the reality is that those regulatory authorities may or may not be adequate depending on how this entity and other entities decide to constitute themselves legally, which I think is still evolving and a little unclear. With regard to your second question, which is also a very important question, we really don't have that kind of authority. So it would really lie elsewhere. The other point, which I think is implicit in your questions, is any of these entities that start from day one with global scope and global scale require a tremendous amount of cross-border cooperation among various regulatory authorities in different jurisdictions. And each jurisdiction has different licensing authorities and different regulatory parameters, and that is one of the reasons that the G7 is spending a lot of time on this. This is something where we are at the FSB working a lot on this. It is inherently going to require a lot of cross-border cooperation with sets of rules that are quite different in different jurisdictions.
Thank you very much. James Fawcett from Morgan Stanley. I had, I guess, two questions to a little bit dovetail on your previous response. I guess, and it may be the impossible question, but how do you manage and work through the coordination of across all the different entities, both internal and internationally, particularly when for the large technology companies, it's become somewhat in vogue as a go-to-market just to launch without permissions or compliance with regulatory and deal with the consequences later, firstly. And then secondly, as it relates to the FedNow project, I guess the question is, why kind of start and build a new network instead of just taking advantage of a clearinghouse type structure, et cetera? Thank you.
So let's see. With regard to can you reframe the first question?
Yeah, sorry, disparate questions. The first is just like, what are the tools that the Fed and other regulators can put in place to coordinate, particularly when many technology companies are happy to launch without approvals, et cetera, and just deal with the consequences later?
Got it. So within borders, essentially, when activities have not sought particular licenses, but actually fall within the definitions of certain financial activities that are covered by financial regulations, they will get scoped in by the oversight of the relevant authorities. And that's what the discussions over the past several years, actually, starting with cryptocurrencies, have been about at places like the CFTC and the SEC. So when new activities arise, they may well fall under existing regulatory parameters according to the legal provisions, whether or not the innovators believe that or designed it in the first place. The thing that I think is really important, though, for that question and the previous question is just the reason the financial system has these safeguards that have been built up over decades is because there have been so many instances historically where financial panics have fundamentally disrupted economies and where consumers, households, and businesses have found that their financial holdings were not as safe as they had anticipated. And that is why we have these very important safeguards in place. With regard to FedNow, there are a few reasons. First of all, the Fed is the only entity that actually can facilitate real-time settlement between the accounts of banks directly. The private sector entity, by necessity, is a private ledger that is a joint account structure. And so if we don't build that capacity, it simply won't exist. And for purposes of resilience and for purposes of kind of future-proofing real-time payments, it's a very important function to build. Secondly, the Federal Reserve connects to 10,000 institutions, depositories, and other institutions around the country. The clearinghouse and its various payment systems often sits alongside the Fed and offers payment solutions in ACH and electronic funds transfer. So this would be the norm rather than a departure. But it's only the Fed that tends to make connections to the 10,000 institutions that facilitate payments. And we have the existing network and customer service built out, which is a lot of work to go that last mile. So we're really building on existing infrastructure in many respects.
Go to the standing mic, please. Thank you.
Dion Rabowen from Axios. My question is just on the, I guess, the state of things or where we are at the moment. I just came from a presentation with David Marcus from Libra, and he seems to be putting forward the notion that they are ready to go kickstart things as soon as they can kind of get the approval. So I'm curious, where is the Fed with an example of, or with an actual presentable U.S. digital currency? I've heard from some members of the Swedish central bank that they are around 5 years away. The Chinese central bank says they've got something to produce by November. So I'm just curious, where do you think we are with regard to actually having a Fed-produced or Fed-backed digital currency, and where do you see the rest of the world?
Yeah, so the two jurisdictions that you mentioned, and I think you'll get to hear from one of them on this panel, part of what is present in their payment system is there has been a very rapid migration away from cash to digital payments. The reverse has been true in the US. We have a lot of movement into digital payments, but we also have a lot of growth in the demand for cash. So we're in a somewhat different position, and I think we're also in a different position because of the nature of our sovereign currency and the role it plays more broadly. With respect to, as we think about the potential evolution of other jurisdictions and their consideration of central bank digital currencies, I think we will watch those developments very closely and look forward to learning from them. We will make important investments in future technology, for instance, to give the consumers the benefits of real-time digital payments, but we're also going to be exceptionally cautious and mindful of the profound differences a full-on central bank digital currency would imply along the lines that I outlined earlier in terms of consumers having accounts directly with the central bank, very profound implications for visibility into individual transactions data, implications for monetary policy transmission, and potentially for financial stability. So all of those things require a lot of careful consideration.
Question, comment? Really? Someone back there. Who's being pointed to? No? Okay.
You mentioned the speed of cross-border payments and the opaqueness of that process, and I guess it's also error-prone to some extent with SWIFT. Santander seems to be trying to approach it with a partnership with Ripple. Just curious what your thoughts are on that.
So I do think that of the use cases out there, cross-border is one of the most compelling. We know that intermediation chains cross-border are long and quite opaque, and they're slow, and they can be quite costly. So my sense is that technology with the appropriate safeguards could make a material impact and likely will, and it may well be through a partnership model. I don't want to pronounce on any particular approach, but there are a variety of partnerships out there that are trying to innovate and to reduce frictions and increase transparency for those cross-border transactions. In my sense, I'm fairly optimistic that there are some good solutions out there that don't necessitate a global stablecoin.
Other question? Please. No. Well, here. Sorry. Yeah.
So following up on that a little bit,
Sorry, this was Frank Brosens from Taconic. Could you add-
Julia Coronado, Macro Policy Perspective. So you laid out some of the issues and the challenges, and some of them seem like there are solutions to those. So for example, couldn't the Fed approach the two-tier system with digital currency with consumers, so that there's a payment system direct to consumers, that the Fed has the reserves, but it's through private sector providers, much as there's a two-tier system in the banking. Like, and you mentioned that the Fed doesn't right now have authority over payments providers. Does anybody have authority over payments providers?
So the way that our system works currently, and has for quite a long time actually, is that the Fed has been given authority to operate as a payments provider rather than to regulate and oversee payments providers, except the authority we have with respect to bank service providers in particular. So we do have capacity to provide those payment services. We currently do that through the intermediation of banks. Through the accounts that depositories and other institutions have with the Fed. One could think of other ways of doing it, but that's the way that we currently operate. And in terms of other regulators, FSOC has some authorities in that regard, but these would need to be determined to be systemic. The payments and settlement and clearing systems would need to be determined to be systemic with very particular statutory requirements. And again, it's not clear that those would be satisfied at this time.
But what about like the possibility of the Fed operating a two-tier system through a CBDC, like using the private sector, not necessarily maintaining all the accounts themselves?
So there are a variety of different ways to think about a potential central bank digital currency. We do, in fact, have a two-tier system in many respects right now, so that we issue digitally central bank money, and the intermediaries are the commercial banks that then provide those services to consumers. Some of the proposals, in fact, the large majority of the proposals that are out there that are really at the forefront of this discussion really mean moving to direct-to-consumer, direct-to-household account provision. So that's a really quite big leap from where we are today.
Please, if you could go to the microphone.
Brennan Greeley, also with the Financial Times. One of the chief arguments for stablecoins like Libra is that they improve digital inclusion or financial inclusion. Is that an argument that resonates at the Fed? And should the Fed be doing something in parallel to also increase financial inclusion?
So I think the arguments with respect to financial inclusion are also compelling, but it's also important to make sure that in the process of extending account access, that we don't end up providing accounts with little to no safeguards to those who don't currently have accounts. And so what really matters is whether in the process of expanding access to accounts and financial inclusion, that all households have the same kinds of safeguards in terms of their claims and the confidence that they can have that they understand the terms of their accounts, and that they have the same kinds of assurances that other consumers have traditionally assumed with respect to bank accounts. So yes, I do believe that the financial inclusion objective is an extremely important one, but I also believe that those kinds of households also need safeguards and protections on their balances, perhaps even more than the current banked population.
Governor Brainerd, if I could, on behalf of the international economics part of the Peterson Institute, can I pose a couple questions? You mentioned in your very excellent speech in passing about the huge private payment systems in China at the moment. And I was just wondering if, in exchange with discussions with the People's Bank or the IMF or others, you think that there's any relevance of that experience, any things that would be more reassuring, less reassuring, or if it's unique. The second question, which may be more to some of your past roles, but we're currently aware of desires of various governments to get out from the potential leverage point that SWIFT and the U.S. payment systems presents over them. Governor Carney sort of came at this in his remarks at Jackson Hole. We've seen the Russians recently announce they wish to create an alternative payment system to help the Iranians. At what point does the creation of these cyber currencies run up into those kinds of issues, if at all?
All right, so let me see, going back to the first question. So actually, I don't know if you're going to have some discussion of the Chinese experience today on your panel, but I really think it's very instructive. I think the two big payments, the two big networks, which turned into massive payment systems in China, really do offer some really important lessons for the rest of us. And what those payment networks were able to do with the data that they had and the access they had, I think is very helpful in thinking about the potential benefits from being inside one of these networks and how these networks can grow very rapidly. And once those network externalities start to build, how they get somewhat locked in. And of course, they present some challenges to the monetary authority. And so I think that will be, that's a really important example, certainly in my own thinking. And I hope you'll be able to talk more about that here today. But the inherently global nature of some of these existing networks, I think, does explain why on day one, regulators across borders started speaking to each other. We do, in fact, have some ability to work across borders in regulatory supervisory colleges, for instance. And so we have developed these kinds of solutions for global systemic infrastructures before, and those are the kinds of arrangements that will be critical for some of these entities if they do satisfy the necessary regulatory and legal standards that I think they must. Second question. So one of the biggest benefits to many of the users of first generation cryptocurrencies was, of course, precisely that it was outside the regulated payment system and was opaque to money laundering and counter-terrorist financing authorities. And that kind of dynamic will remain. Of course, we have a tremendous amount of cooperation across a lot of jurisdictions in this shared objective. But I do believe that part of the reason that you see interest in some of the less opaque types of crypto assets is for illicit activity.
Is there a final question for Governor Brainerd? Yeah, we've all got somebody else who's got a second bite at the apple first.
Thank you very much. I just wanted to ask a follow-up question here, and that was, obviously the U.S. position or the U.S. dollar position as a reserve currency has helped create a lot of demand for cash. One of the arguments that we hear around digital currencies issued by other countries is that the digital currencies distribution advantage, electronic distribution advantage, could serve as a path to unseating the U.S. dollar as a key reserve currency. What's your view in terms of that potential and relevance?
Yeah, so I think what is, I have to say what I have, and now I, may just step out of my Federal Reserve kind of perch for just a second and say, having observed the role of the dollar now over many decades, it is really notable. We've had massive changes in the international monetary system in terms of growth of certain economies, the emergence of other global currencies. It is notable how stable, in effect, the reserve currency's role has been. And I think historically, we also have seen that it requires a very unusual and low-frequency set of events to switch from an existing reserve currency to another reserve currency. The set of developments that we're witnessing today are another wave that raises those questions yet again. It certainly is something that I'll continue to watch carefully. It's not something, given our statutory and domestic responsibilities, it's not something that would change the considerations that we would bring to bear in thinking about the costs and benefits of moving to an entirely digital central bank currency.
Thank you so much. If
you.
you could please join me in thanking Governor Lael Brainerd of the
Thank
Federal
you.
Reserve. We'd like to invite those of you present with us today for a 10-minute break to accept our modest hospitality and our ample food for thought we already have. In 10 minutes, we will reconvene for a presentation by Marcus Brunnemeyer of the new study. I'll make sure I get the title right, The Digitization of Money by Brunnemeyer, James, and Landau, and then the panel moderated by Martin Wolf. Thank you very much.
Yo, I gotta say, man, that was pretty. I literally was searching, like, for everything right now, and I literally saw this being broadcasted. I was like, you know what? Why not stream this? I was like, yeah, so let's just stream it. So there's gonna be a 10-minute break. We're gonna talk a little bit about some stuff that was happening on Twitter and some sort of things right now. Hold on, let me just close my door real quick. Okay, yeah, but yeah, so there were some things going on. We'll wait for the 10. Actually, no, there is no 10-minute break because I actually put this a little bit off so I could stream the whole thing. So actually, we could start right now. So okay, so this is, who is this? Someone from Princeton University gonna be talking about some stuff, and then at the end there's gonna be someone from BIS, Bank for International Settlements. So let's just get started with the next part. Actually, hold on, let me search his name real quick. It was somebody from, I'll put it in the chat. But yeah, so let's just get started on the next part of this conversation. And this is live, but I wanted to stream the whole thing so we could get everything. So yeah, it is a little bit delayed. But
About that break, especially for those of you online, I hope you pushed pause and restart. It is my pleasure to continue, we hope, the incredibly high standard that Governor Brainerd set for this discussion on substance, and I'm certain we will. We will now have a presentation by Professor Marcus Brunnemeyer of Princeton, of the Bentheim Center for Finance at Princeton, of his new paper with Harold James and Jean-Pierre Landau, The Digitalization of Money. Marcus, please.
I would like to thank the Peterson Institute, and especially Adam and Frank, for hosting us on organizing this together. I think it's a pleasure and hope we can do this in the future again. So as Adam said, it's joint work with Harold James, who is also in the audience, and with Jean-Pierre Landau from Sciences Po in Paris. Oops, this is the wrong way around. Okay. This was the last slide. So we would like to rethink money in the digital age, and everybody knows that there's a revolution going on. There's M-Pesa, Alipay, Libra, everybody's talking about it. But you might argue that we have digital inside money already. So most of our checking accounts, everything is in digital form already. It's inside money, not outside money. So it's a liability for some bank. While the new thing, I think, is very much you have digital outside money, so money which is not a liability of somebody, some new currencies. And the questions which emerge in this discussion are always, will private digital money drive out cash, public tokens, essentially? Will central banks lose their grip on monetary policy? Do we see digital dollarization, as Governor Brainard mentioned? What are the new digital currency areas? There will be new currency areas. What space will they take on? And will CBDC be the answer to have the grip, holding on the monetary sovereignty in a sense? And the actual thing you might think is what's actually new in this setting when you have technological trends already, and we have already e-money at this debate about the cashless economy already 20 years ago. And I would like to make some arguments that this time is different for the following reasons. One is that what money now is much more associated with digital platforms. So you're part of our ecosystem, a digital ecosystem, where part of your life is, your digital life essentially is, you live on this platform. And that gives this platform some data advantage they can use for other purposes as well. That's very different from previous e-monies, where actually it was not part of this digital platform where the data played this crucial role. I think that's one important point I will come back to over and over again. The other important point is that everything is on the smartphone, so it's easy to carry around. It's within tokens, you can make tokens. And put this together makes this much more speedier world. So the payments will occur in real time. People demand to pay in real time. You can't wait for 2 days for some payments to be happening. And that means much less can be netted out within the bank. So you have to have much less netting. So you have much more cross settlement going on. And when there's a crisis, of course, the crisis will be much faster. There will be no weekend or anything to deal with that. The other thing which will happen is the Internet of Things. There will be payments from machine to machine, not only from person to person. There will be smart contracts and in value chains. So a lot of contingent payments. Whenever something happens, there will be contingent payments. There will be a lot of volume coming from smart contracts executions. And finally, of course, you have tokens instead of account-based systems. So all of these things might impact money, and we would like to highlight some of the aspects which money might be impacted. So the first thing I would like to is that the currency competition will change, and it will change in one way that it leads to some unbundling to the three roles of money. So typically we have this unit of account role, the store of value role, and the medium of exchange, and Hayek already postulated in the 70s that we should actually have some currency competition because this actually keeps the governments in check not to print so too much money. But the currency competition didn't work so fiercely, in particular with respect to private aspects, because whenever you hold some money, you get the bundle of services. You don't get just one store of value service or unit of account or some medium of exchange service. That actually limits competition among the currencies. But in the future, you can hold 37 currencies in your wallet or in your smartphone. You can switch from one currency to another one very easily. You might prefer a particular currency to make payments on that platform and a particular currency to have a store of value, so you can easily switch around. So you can see much more fierce competition among the currencies because you have this unbundling of the three roles of currency. Of course, it's not new. We have already convertibility between gold and silver historically led to some unbundling where you use silver much more for payments as a medium of exchange and gold much more as a store of value and for larger transactions. So the Gresham's law is essentially also a form of unbundling. But more generally, it will be the case the switching costs from one currency to another currency is going down. This reduces network externalities, and that actually then leads to much lower forms of much fiercer competition because you have this unbundling. And one nice analogy, I think, is what often people say, that money is, we coordinate on a particular money is like language. We also coordinate on a particular language. So we use certain sounds and communicate with certain sounds. And we coordinate on these languages, and it's very hard to switch from one language to the next one. But once you have the speech translation software, where Skype or whatever software it is can translate immediately what we're saying in another language, then it will be the same, that we don't really have to coordinate on the same language anymore. So everybody can have his own private language, and we just coordinate very easily. We don't have to coordinate on some language, so we can switch. The switching costs will be much more reduced. Now, the key thing is that there will be unbundling in the roles of money, but there will be rebundling at the same time. And the rebundling will occur with certain features of the platforms. So you will live on the platforms, on the digital platforms, or the digital ecosystem, and people will provide, or institutions will provide, certain currencies which are very well suited for this particular platform. So there will be discounts if you use this particular currency on a particular digital ecosystem. You can execute smart contracts if you use this currency. You cannot use the smart contracts otherwise. And there will be, in general, there will be institutions providing currencies offering different features with the money attached to it. So there will be a rebundling with other features, and there will be what I call this money product differentiation. So there will be some monies which are very good in providing price transparency in this particular platform. Others will be more currencies which have more privacy protection. So Apple Pay is actually already going this way. So if you want to have particular privacy, if you're very concerned about privacy, you might use a certain currency. If you're not concerned about privacy, but much more about how many points you get or miles you get or other things, then actually use a different currency. So that there will be competition among these various things. And of course, this differentiation is designed to reduce competition among the currencies. And to a large extent, the private sector will have an incentive to make essentially each ecosystem more closed, so to make it less interoperable among the systems in order to get some rents from using this currency. And this will lead to then to some digital currency areas. Okay, you have certain areas which are not geographically designed, but differently designed based on connections to a digital platform where you have various different digital currency areas. Now, this has already immediately implications for the international monetary system. So as you say, there's this digital currency areas, there's complementarities with digital platforms. As I mentioned, you might get certain price discounts. If you look at China, that's where it's very much advanced in this space. You can see that the way Alipay and WeChat Pay got big advantage was because they offered essentially some discounts if you use Alipay or WeChat Pay for certain shops. So they went around to the shops and we give you special discounts, and then people use immediately Alipay or WeChat Pay, and the cash usage went down dramatically. Similarly, you can have better price discovery, you can have fine-tuned price discovery depending on the type of consumer you are. You might get more transparency if you're in this particular platform using this currency and so forth. So whenever you have your own unit of account, we call it a different digital currency area, or the payment instrument can only be used inside the digital currency area. And as it came up earlier, there's also digital dollarization in a sense that there will be some vulnerable countries. So like with traditional dollarization, that suddenly the country loses its own currency and people suddenly start using dollars or whatever the leading currency is, the same can also happen in a digital space. And the question is, which countries are most vulnerable to digital dollarization? And this probably, like for dollarizations, will be small countries, but it will also be countries which are relatively open, which don't have their own social media platforms, where the citizens already rely on a social media platform from other countries. And that these countries are much more vulnerable to digital dollarization, and that means they might lose part of the economy, might move to these platforms, and they also might lose the monetary sovereignty over that. And the next thing is, of course, the key is that when will you lose the unit of account role of money, and with it then the monetary sovereignty. And as we know from the dollarization literature, this is a highly nonlinear system, a nonlinear phenomenon. It might not happen for a long time, and suddenly it happens very quickly. So what Rudi Dornbusch said about financial crisis also works here for dollarization. First it takes much longer than you think, but when it happens way, way faster than you think. And how digital dollarization will happen, it can happen in two ways. It can happen like traditional dollarization through the medium of exchange role, that people start invoicing and exchanging services with this digital currency, or it can be with the store of value role, where the new currency serves as a store of value. And you can see that, for example, if certain countries have capital controls on it, it might not become very a dominant player from the store of value because of capital controls, but because of the medium exchange role it serves on this platform, it might become a very attractive currency to take over other countries because of the medium exchange aspects to it. And finally, the third implications for the international monetary system is the digital synthetic world currency. I just was at the IMF, and they're talking about, some people were arguing, there might be some SDR based on digital currency. But overall, I think what's important is you would like to have this safe asset people use and symmetric supply, globally symmetrically supplied. And the reason for that is whenever there's a crisis and there's flight to safety, it leads actually to flight to safety across borders. And that's further destabilizing because everybody holds, let's say, the US dollar or dollar assets as a safe asset. And whenever the crisis becomes more severe, even if it's started in the US, it will lead to an appreciation of dollar and a lot of cross-border capital flows. If you have a safe asset which is more symmetrically distributed across the globe, a truly global safe asset, you will not have this cross-border flight to safety flows. You might still have flight to safety flows, but they don't lead to huge exchange rate movements and then destabilize further because of the exchange rate movements. And that's one argument why you should have actually a more symmetrically supplied safe asset. Now, the other aspects beside the big aspects on the international monetary system is it will also change finance as we know it. And the question is, who is controlling the data? And there are two worlds out there. One is a more bank-centric world, and the other one is a more payment-centric world. And the bank-centric world, that's the world we live in at the moment. That's much more centered around banks, and the banks have access to the customers directly. All the lending, deposit taking, payments, everything is going on the bank side. And the bank has a lot of information about the customers. It can make use of this information, whether they give a loan or don't give a loan and so forth. The payment-centric world is what we see already in China, where the payment platform is at the center and the information is with the payment platform provider. And the banks essentially just feeding funds to the payment platform, but all the information rent is with the payment platform, and they provide then the services with that. And then the question is, what is the optimal way of bundling it? Is the optimal way of bundling is deposit taking and lending? Is this the optimal way of bundling activities because they need to have the common information? Or is the optimal way of bundling payments with some other e-commerce activities or other social network activities? And that's the key question we have to answer going forward. And it's not clear ex ante how the system will play out. Of course, the regulatory framework will play a major role which direction one goes, and probably some countries will go more the bank-centric way, and other countries will go more the payment-centric way. Now, let me come back to the currency competition, in particular to the competition between private and public money. So between the sovereign, its own money, and the public. And the question essentially becomes very dramatically phrased: is Facebook doing the monetary policy to manage our macroeconomy? Is Facebook our new central bank if Libra is taking over? And you might think, if you think about it, public money is the most natural thing. Each country has its own currency, but it's, as Harold told me, this national money is a very recent phenomenon. Harold, of course, thinks in centuries rather than in decades. And so it's a fairly recent phenomenon that we have national money. For many, many centuries, we had many private currencies competing with each other, and there was no nation behind it, because nations is also a fairly recent phenomenon. And so the question then is, what's the advantage of public money versus private money? So of course, one argument is, historically, didn't really matter so much because we didn't really use monetary policy so much if you look 200-300 years back to manage the macroeconomy. Nowadays, we really need monetary policy to manage the macroeconomy, so we have to be more concerned about monetary sovereignty. But what really makes public money special, there are three arguments. We're going back to the three roles of money. One is the store of value focus, and that's because in order to defend a currency, how do you defend a currency if there's an attack? You have the tax backing, you have the taxing authority, you can raise tax revenue in order to fend off any attack. The question is, will Facebook use its balance sheet? Will it go beyond its balance sheet? How much capacity is there and how much willingness is there to defend your currency? Of course, there's some examples where there's some public money which is then the government disappeared and it's still active and was still active for many years. So one example mentioned famously by Mervyn King in a famous speech at the American Economic Association, the Iraqi dinar, even though Saddam Hussein was going down, and the Iraqi dinar in North Iraq was still active, acting as money very well, in particular because nobody could print it because there was no government. And similarly in Somalia, the Somali shilling is still actively used, even though there's no government anymore and no central bank. So you can have money without tax backing, but it's more the exception rather than the rule. And the other thing is, the second aspect is the medium of exchange focus. Some people argue it is the legal tender aspect, and the government can enforce certain payments and being made international money. So that's another focus. But I think we think the key aspect is the unit of account role of money. And as long as you can control the unit of account role and people denominate essentially nominal debt in your own currency, then you can control essentially monetary policy. And the argument essentially is what monetary policy does in a world with financial frictions, it can essentially shift risk around. So whenever it can do monetary policy conditional on the risk. So let's suppose we have a Brexit, it can be hard or a soft Brexit. It can conduct monetary policy subsequently conditional on that, and this way we can shift risk around to a much broader part of the population than to the guys who trade derivatives on this particular risk. And that's what monetary policy does. It allows a much better risk sharing across the population in a world where we have nominal debt denominated in the national currency, or alternatively, we have a price stickiness in this, in a New Keynesian perspective, a price stickiness in this nominal currency, which, if you think about it, is essentially also a forward contract. You have a wage contract for the next 1 year. It's almost the same thing as denomination of forward contracts or nominal debt. So it's the intertemporal aspect, the intertemporal numeria, which matters a lot for the unit of account aspect. Now, the final point I would like to make is that, as cash becomes a pure substitute for private digital money. Why? Because more and more parts of our world is actually is executed at a digital platform. We would like to have some digital money, and cash is not well suited to use on a digital platform. So cash is going away, and I think as people argue, there's more usage of dollars and Swiss franc, but it's mostly used as a store of value. So because the interest rate is so low, we all having now suddenly, we want to get around the zero negative interest rate in Europe or in Switzerland, so people hoard to some extent some cash, but the actual usage of cash, the velocity of cash is probably going down and becoming less prominent as we speak. The question is, so how can we offer some alternative? And I think that's the first order aspect when you think about central bank digital currency. Can you offer something in order to maintain monetary sovereignty? And you want to maintain monetary sovereignty in order to ensure that you have the power of monetary policy still active. And one way, this came already up in the previous session as question, is to have a more indirect way that you have stable coins, and the stable coins, some of them are private, but they have to back it with 100% of the central bank digital currency. So that's 100% CBDC. Or you can go the full way, just saying everybody can have some account with a central bank. Many people argue it should not be account-based, but token-based. So it should be very close to cash. like cash is a token, so it should be much more token-based. There's also, in terms of privacy reasons, you cannot keep this more private when it's token-based, and it's much easier this way to keep it similar to cash and probably get it more accepted from the public as well. But of course, the question, I think, which will probably come up later as well, the question is whether some official CBDC will have these other bundling features with various platforms going on. The next question essentially then is, how would you design the central bank digital currency in a way which is neutral to the real economy? The argument is always that if the central bank is introducing a CBDC, it will be the case that you drive out essentially deposit taking, so the banks can offer fewer deposits, and this way the funding you chalk off some investments, because the banks can actually not issue so many deposits, they have less funding, they can actually fund less the real economy. And let me just show you with a quick picture a little economy where you have some firms here, there are some banks here issuing deposits held by the households, there's a central bank and the government also issuing some money. And now let's suppose we increase, let's suppose that's CBDC already instead of a green piece of paper. Now, if we increase the amount of money, one way to maintain the neutrality is if the central bank would just pass through the funding through the private banks. So you can design a system with pass-through funding to make sure that you have still the equivalence, even though you introduce CBDC and you drive out some of the deposits, if the central bank takes over some of the deposits. But then you might argue, of course, the central bank then becomes a creditor to private banks and is exposed to credit risk, but you have to put some safeguards in here as well and have to adjust the lender of last resort policy in a particular way to make sure that the safeguards are in place. So let me sum up to the main points of the paper. The main points of the paper is that the world is changing in particular ways. We have e-money before, but what's really the new aspects which drive things are the digital platforms and the digital ecosystems, where a lot of our transactions will move to. Retail is moving with Amazon and many, many other things will be executed at digital platforms rather than physically going to a retail store. And for that, digital money is way more useful than cash is. The smartphone is the second element, and token-based accounts. These are the three elements which really make this very different from the earlier movements. And what we will see is essentially some specialization in currencies where they unbundle the three roles, the traditional three roles of money. And this unbundling in itself enhances currency competition. So because unbundling leads to competition in each of the functions of the money, so you can have much more currency competition on this dimension. But there will be some rebundling which reduces currency competition. And in order to make sure that the private sector doesn't do too much rebundling, you would like to have some interoperability and convertibility. And so the big policy issues is how interoperable are the various currencies with each other. So typically the private sector probably has an incentive that you'll go to the platform, be locked into the platform, and it's not so easy to get out of it. So it's easy to get in, but more difficult to get out, and that's where the interoperability issue comes in. The second point is more with regard to the financial sector. There will be an inversion of the industrial organization of the financial activities. There will be, the big question, who will have access to the data of customers, the banks or the big tech companies? And there will be a lot of lobbying activities who can actually maintain the access to the banking sector, to the customer's data set. Will it be the banking sector or will it move on to the big tech environment? And of course, if we want to move to the latter, there will be a huge transition period, and this might also be associated with some risk on it, and it might make sense not to experiment with the US dollar right away, but as Leland Brennan said, experiment with some smaller countries at the forefront of that. But I think the two important concepts are this digital dollarization, which is an issue for smaller countries, but countries which don't have their own social web system. So while they rely already on current IT and big tech companies from US or from China to a large extent. And then there will be new digital currency areas popping up. These digital currency areas will not be based on geographical boundaries, but there will be on different dimensions. There will be some people in different parts of the continents who actually might belong to a similar class of consumers and who have then a similar currency they're dealing with. I should say one final word, of course, what we discussed in the paper too, the specific areas for which there will be a digital currency will also depend very much on privacy regulation. Okay, so if there's particular privacy regulation, then it will be the case that you will also have specific currencies which take advantage of this privacy regulation, and this might introduce some geographical boundaries after all again. And finally, I think the most important question is what to do in order to maintain monetary sovereignty, to manage the macroeconomy. And for this, I think the important role is the CBDC. So it's very important to have this role to give the central bank some access to the public, in particular to ensure that nominal debt will remain to be denominated in your national currency. And only this way you can actually maintain an ability to manage your macroeconomy through monetary policy. Thanks a lot. So I think we're going to the panel. I don't see Adam. Okay. I think the next, I don't even think we have a break. We go on to the panel right away. And Martin Wolf will actually.
Okay, so it's a great pleasure to moderate this session. I agreed to do so because I thought this whole seminar would be a wonderful learning experience, and it has been. I have Oh, I see. I thought this was automatic, as it normally is. Okay, I'm very happy to moderate this session, and I thought I wanted to do so because I thought I'd learn a lot, and I have, and expect to learn even more in the panel discussion. I've actually read the joint paper that Marcus just presented, and I had to read it twice to understand it. So if you understood his presentation, you are impressively bright people, or impressively well informed. But it is incredibly important and provocative, though. I think it leaves some questions. In my own perspective, and it's just sort of the last remark of mine, is all this terrifies the wits out of me. My basic starting point is that whenever you allow very major innovations in the financial and monetary system, it always ends badly for about a century. And at the end of that, you sort of work out what to do about it. And by then, civilization is almost gone. So I am not being facetious. I'm being absolutely serious. So I think that anybody who isn't worried the hell out of a world in which Facebook runs the monetary system, or maybe Amazon, then they're just not paying attention. The way we're going, the panel, I have, we have 4 people. It's Mark, are you still in the panel? Are you going to participate in the panel? Would you want to? Good idea. But perhaps at the end. So in the Q&A, perhaps. So we've got to my left, Stefan Ingves of the Swedish Riksbank, the oldest central bank in the world. Yes, so you know all about the consequences of innovation. I'm sure you've made mistakes many times. To his left is Hyun Song Shin, whom I've known for a very long time. who used to be a very, very distinguished, enormously brilliant academic, and for some reason has become a bureaucrat. I still can't work this out. And third, Simon Potter, whom many of you will know from the New York Fed, where he was executive director. Is that your head and the head of them? Yeah. So the way we're going to do this is we're going to just have a discussion. It's not going to be a lot of speeches. I'm proposing that we will divide into two segments. The first segment will discuss how digital technology is set to transform the monetary and to a lesser degree financial system. So taking on from what Marcus was just talking about. And the second section will be about how they expect the public sector, the official sector, particularly central banks, but not exclusively, to respond and how they think it should respond. Each segment will be about 25 minutes, and then we'll have a discussion. Now, some of you might have noticed that we haven't done fantastically well on timekeeping, but my view is the past is bygone, so we are still going to have our full length of seminar, and that means that you're not going to have very much time for drinking afterwards, but you might have enough time to sink a few glasses of wine to get over the horror. So the first section then will be on how this could unfold. Each panelist will speak for about 4 minutes, then we'll have a discussion among them, then we'll move on to the next thing, and then there'll be lots of brilliant questions from you. And to start off the first section, Hyun.
Well, thank you, Martin, and thank you to the Peterson Institute for laying on this very timely and very interesting event. It's been a extremely rich discussion so far, and I've certainly learned a lot. We've talked a lot about technology, but I think it's very important for us to keep in mind the technology in the context of the architecture. So the tech is one thing, but architecture is about what we do. Tech is about how we do it. And I think, of course, clearly the technology is enabling, and that will actually have an influence on the architecture. But it doesn't always have to. And I think a very good example is account-based money. And I think it's worth thinking about the origin of accounts back in, I suppose account-based money really took off in 16th and 17th century Europe, where the idea is that there is an intermediary, both the sender and the receiver have accounts at this intermediary. It's typically a bank, and the sender's account is debited, and the receiver's account is credited, and that's a very elegant solution. Now, that architecture is pretty much in place right now. It's just that the technology has made that functioning much more efficient, very rapid, and very much more convenient. I mean, if you're in Sweden and you have a bank account, which most people have access to, there is this digital app called Swish, extremely convenient. Just one swipe of the, one swipe on the mobile phone, and the payment is made. It's very much based on the banking sector. It's very much based on the two-tier banking system where the payment goes through one account at one bank to another account at another bank, and it's settled on the central bank's balance sheet. But the technology has, of course, made it much more convenient, and the look and feel is extremely sort of seamless. So I think that's a very good example of how the architecture can remain pretty much constant, but the technology enables you to do much more. Now, we're here because technology has stirred up a number of other debates. And I think there are two issues that I think which have really been very important in making this topic particularly topical. One is that we have a way of making payments which doesn't need the account-based money, which is based on a decentralized consensus. We typically call it a token currency, but it's not really, I mean, that's really a shorthand. What it does is it's a list, and the list is shared among everyone in the network. In Bitcoin, it's a completely open system where you can come in and be a member of this network. But it's just a list that keeps track of where a particular unit of value has been transferred. And technologically, I think this is elite because you don't need to debit one person's account and credit another person's account. I think this has really occasioned a very stimulating debate. Now, it doesn't need to be Bitcoin, which is which is an open DLT system. It can be a permissioned DLT system, as many central banks have also experimented with. But this tech development has been a very important development. The second development, I think, is, as Governor Brainerd mentioned, the importance of big tech companies that have come into financial services. And big tech is characterized by what we in this year's annual economic report call the DNA loop, the data network activities loop. So big tech firms already have an established base, either in search, in e-commerce, or in social media, and then they're leveraging their network in providing financial services. And so the entry is much easier, and there's a potential where there could be a tipping point where they could become very important players in very short time. And if so, they would become really, very important market participants, even dominant perhaps. And that could actually change the competitive landscape in a way which may be detrimental to something which is a more competitive, transparent system. And I think this has also occasioned a lot of debate. Now, so Martin has been a very tough chairman. I do have a slide deck which has been distributed to you, and in that slide deck, what you'll find is that in a typical advanced economy, and there you have an example of the member countries of the Committee on Payments and Market Infrastructure, which is a BIS committee that oversees the payments space. Typically, wholesale payments are of the order of 50 to 60 times GDP. That's to say, in a given year, if you just count up the amount of payments that go through the central bank overseen system, you have quantities that are vastly larger than GDP itself. That's wholesale payments. The retail payments turns out to be a very much smaller component of that. And if we were to try and replicate that with a stable coin, for example, where it's pre-funded, so you deposit money into a wallet and then spend only the money that you have, we are thinking of a wallet that would be an enormous wallet where you have very, very large sums. And in macroeconomics, that's called a cash in advance economy. If you try to operate the modern financial system as a cash in advance system, you would really come up against big bottlenecks. The reason why the central bank-based system works so well is because people trust the central bank. And when the central bank offers a deposit as an overdraft, you're creating a loan that's backing the deposit. But in a daylight overdraft, which is typically what happens in a wholesale payment system, that daylight overdraft is granted to a bank, let's say, because the bank can make a large payment, even though the balances that the bank has at the central bank doesn't cover the full amount of that payment, because the timing of payments will be such that at the end of the day, you will have all the accounts being balanced. And I think this gives us a very useful introduction to the question of what is the appropriate division of labor between the public sector and the private sector. To the extent that, as Marcus also mentioned, the public sector is very good at providing a backbone to the system, which is trusted, and the private sector can plug into that system in a way that's conducive to competition, in a way that's transparent, and in a way where the private sector can do what it does best, which is the customer-oriented activities, to unleash its innovative capacity in serving customers well, improving customer experience, and serving the needs of everyday users of the financial system. that would be, I think, a very good benchmark for us to start this discussion. There may be some scope for CBDCs, and perhaps we can come back to that at the end. But I think I would go back, so I would sort of finish with my first point, which is it's very important that we distinguish the technology from the architecture. So the tech is something that is an instrumental goal. It's not an end in itself. And I think it's very much, it's incumbent on us to bear that in mind.
Thank you very much, Hyun. I think the distinction you've drawn is very, very helpful. And the way you've thought about it presents us with a different perspective. Let's get back to that very soon. Simon.
So I read your paper 4 times and I'm still learning. Hyun has been fantastic. His presence in Basel has really helped central bankers understand some of these issues, and there are deep issues. In the wholesale system, which you talked about, the progress over the last 30 years has been massive. So Fedwire, that does payments, securities, that's going to do GDP of the US within a week. That was your point. That's $22 trillion. That is an amazing change. There will be innovation in wholesale markets. I find it hard to believe that distributed ledgers, except for safety and soundness, will add that much compared to the account-based money that we've seen there and the role that central banks have. Now, these high-value payment systems, there's been a lot of work to make sure, because they are the backbone, that they work under a number of cases. For example, if there's a terrorist attack, a power outage. And we understand how to do that well. That means they've got to be geographically diverse. You'll be able to switch over well. There's a different problem. If there's a cyber attack on them, this is a really hard problem to deal with. So I turned off my phone now. And suppose the large value payment system is turned off for 2 hours at most, right? That's what the BIS told people. Can this be turned back on? And it looks the same to me, but instead of it being the Apple operating system, it's an Android one, because that's been compromised. That's a big challenge that we're going to have to deal with over the next few years, because we know that these cyber threats are present. So what the world's going to look like might be a lot about how to fight against cyber, because we are digital much more than we were before. The cash is not going to be a solution to that, physical cash. But in a local sense, it certainly can be. So if we're all using phones to trade money, better hope the power system's up. Because if it's not up, it's going to be a problem. And one thing I'm pretty sure about mine is in 10 years' time, if I go to any country in the world and I give them this token, most people will know what this token is. For smaller countries, they might not, but it's a $20 bill if you can't see it. And this will work really well, because the network effect of the US dollar is going to be very hard to change over time. The first time people in one of these countries experience their phones not working, they'll want to have a backup of physical currency. And the other thing I'd say is I don't see people being able to innovate in any way that's good for society and growth, such that taking away cash and having very negative rates will be in a world we live in. I think mildly negative rates, for certain reasons, like Sweden has, you might want to have. But the notion of having a minus 5% rate without changing the financial system in a fundamental way, I think is a pipe dream.
It's very challenging, and come back to that too. Stefan.
Well, thank you. Last night when I read my emails, there was one email saying that I'm a CEO in Silicon Valley, and I'm quite deeply involved in planning a pathway for central banks to absorb and use cryptocurrencies. I get these types of emails actually quite often. So this happens right now, and it's not theory anymore. And that, of course, then raises the question, what is money? Well, money is actually what's in our heads, because money is a convention. That's what it is. And it's a convention which can rely on different technologies, using the plural. And that is also exactly the way it's been in the past. But what it gets hard for us today when we discuss these things is that everything we have today was created about 100 or a little more than 100 years ago. And everything then back then was based on the assumption that everything is on paper. Now we're moving into a world where nothing will be on paper, mostly. And that's when it gets difficult, when we start thinking about these structures, thinking about the architecture. And that's the hard part. Now, part of it is IT technology, but the Silicon Valley man, he's a technology guy, he talks about this from a technological perspective, which is not really the key to money, because you can do this in many different ways. Because money requires a legal framework. And parliaments, governments decide what the legal framework is supposed to look like. You can't really create money out of the blue, even if you try to, calling it Bitcoin or whatever you like, because it's going to require a legal framework of one form or the other. And that also gets you into the public good aspects of money and what money is good for. And that takes us into the field of monetary theory, which is actually quite different from monetary policy, which is a completely different topic. And that means that today, when technology changes, we go through a phase where age-old issues resurface. But there is almost nothing new under the sun when it comes to money, and most of it has actually been tried, and from time to time also failed in the past, but in a world where technologies were different. And I do think that money is too important for the private sector only to deal with. And private initiatives tend to crash sooner or later. But having said that, I do think that we on the central banking side have been too complacent. And we certainly have some homework to do. And I'll get to that during the second item. And that means that it's time to discuss the plumbing. Most people are not comfortable discussing the plumbing. Most people just ignore the plumbing until it backs up. And that's why we have this very, very rare and fascinating seminar and panel here today. And I think that that's a good thing. Let me give you a few examples dealing with plumbing issues, because I'm come from the plumbing side when it comes to money. Today, when it comes to setting up a securities depository system, setting up a central clearing organization, or setting up a stock exchange, all of it is IT, and you can buy this stuff off shelf. In the future, it will be also possible to buy a monetary system off shelf in terms of the IT parts of it. And a fairly large number of small countries will actually be forced more or less to buy these systems off shelf because they can't produce them themselves. It's just too hard to do. And that raises some very fundamental issues, like how do we answer the question, where is my money? If the answer is, it's in the cloud. What cloud? Whose cloud? And that's because IT changes all of this, because we're trained to think about money in physical terms, in spatial terms, and in national terms. And none of that necessarily holds in the future, because let me give you an example. We can create the IT system in country A, we can have the servers located in country B, and we can actually use the system in country C. Now, in that environment, you have to cooperate, you have to standardize, and you have to create trust. And without that, these systems won't work. And what this really means, if you think about money, or using the plural monies from a small economy perspective, usually it's about monetary policy, it's about financial stability, but we have to add a third aspect of it, which is ease of use. And you have to have those three at the same time. And that's how you create a product called money, whatever the name of a currency happens to be, that produces value added. And if you mess up on one of them, you probably end up with a problem, and people will go and use somebody else's money. There are probably very large returns to scales when it comes to setting up these systems. And might be in the future an element of the winner takes all, or if not all, a lot. And that means that nation states will have to make their choices going forward. But one thing is for sure, you can't turn back time. Thanks.
Just let me, since we're discussing what might happen, so we've just got a few minutes to think about that. And I have two questions, and you don't all have to respond. but I'd like to start with you, Sean. I have lots of interest in this idea, this analogy you have, technology and architecture. And I was thinking about that. I was thinking, well, when you're in a building, I'm moderately interested in the architecture, but I'm even more interested in the engineering and the building. It might be beautifully designed, but it's not much good if it falls on my head. Now, we'll come to that in a second, in the second part. But there's another question in this world which we might be moving to, which Marcus has laid out, in which a large part of what the current monetary system does will shift to completely new players, or indeed already has. What do you think the biggest issues are in managing the stability during this transition, which might be long or quick, of all the existing players who do provide the other services? And how do you think about just the process whereby banks lose the payment system? What would that look like? And what sort of problems might that process create?
So, Martin, these are very big questions. And of course, we struggle with this all the time. Let me address it like this. Big techs have become very big players in a number of areas. As I said, they rely on this DNA loop, the data network activities loop, where as they provide services in social media, in e-commerce, and in search, that generates a lot of data. The data is the input into a lot of the activities. And then that begets more activity, which then generates even more data. And in the annual economic report, we cite an example of where credit assessment becomes, if you then unleash machine learning onto this big data, it just becomes a very different game from the usual credit assessment where you're looking at the balance sheet or the income statement of the borrower. Because you can actually look at the whole network, and as the saying goes, you can judge someone by the character of their friends. So if you look at the whole network, you can actually glean a lot more about the creditworthiness of someone by looking at the transactions that that particular player does with all the other members. Now, this does mean that banks, as they which are still the most important incumbents, will face stiff competition. On the other hand, the way that the architecture is evolving is very interesting because, as Governor Brainerd mentioned, I think the example of China is a very interesting example. And there, what you're seeing is, although we have these two very large players who have their own walled garden, as it were, their own network effects, the policy response has been to bring them back into the two-tier system because now they're subject to 100% reserve requirements, so that they are now plugged into the central bank's balance sheet in a much more secure way than they were before. And in some ways, that is coming back to the conventional two-tier system, even though their business models enable them to really harness the DNA loop. So I think what we're seeing is it's not just a one-way street. I think we are seeing an evolution of the system where, and I think this is a lesson for us, where we can aim for a very stable backbone where the public goods are provided publicly. And public goods can be provided privately as well. But I think for the payment system, for the underlying core infrastructure, that's probably best provided publicly by the central bank. And then we allow the full creativity of the private sector with their technology, with the with their creativity in being able to serve customers to do their stuff.
Thank you very much. That sort of elucidates some of what you were talking about earlier. Let's move on, and then we'll all come back. I think that's a wonderful opening for you, Stefan, because you're going to, so we could turn to the question of the appropriate official regulatory and policy response to these developments. John has presented a rather benign view of happy cooperation between the central banks doing the public good stuff and the private sector doing what it does best, particularly in innovating the payments process. In this context, that's the aspect of money we're mostly focusing on here. How do you see, from your point of view, the issues? And in that context, particularly because we know that this is something you're thinking about, the possibility of the provision of central bank digital money directly to the public?
Well, thank you. Good question, Ander, because there's, again, as I said, there's nothing new under the sun when it comes to money, because one way or the other, my institution has made it possible for the public to hold Riksbank money for 350 years. And now we're embroiled in a conversation whether one should allow that to disappear, because physical money is likely to disappear. And that's, at the end of the day, is going to require a political judgment. It's not for central bankers to decide which way that should go. But one way of thinking about this is to say, and here I think I'm citing Benoit Cœuré, who said, same business, same risk, same rules. That's one way of thinking about it when it comes to these new types of systems that are emerging. But let me say a few words about my vision when it comes to where we are heading, and I'm of course talking about this from my own national perspective. And I think it's important to keep in mind here that where money and payment systems are intertwined, and that's really, really the key to it. And so my vision when it comes to all of this, and I'm of course talking about it from a central bank perspective, because my job is to produce Swedish kronor, and my job is to make sure that that's good stuff and that people use it in a world where there's a bit of competition. So 6 bullets that I have in mind. First, it should be possible to make both large value and retail payments in central bank money in real time, anytime, 24/7, all year round. Second, when it comes to this, it's also important over time to make sure that we can make cross-currency and cross-border payments, at least for low-value payments in central bank money in real time and also at any time. Third, it should be possible. There should be a definition of legal tender that is suited for the digital age. In our case, digital legal tender is tied to physical banknotes. And if banknotes more or less disappear, people don't use them anymore, well, then we don't know what legal tender is anymore, and that becomes an issue that will come back then that we have to deal with. Fourth, there should be a digital currency issued by the central bank, and that digital currency should be legal tender. Now, there is a distinction here between wholesale central bank money and retail central bank money. So I'm not talking about wholesale, because that we already have and have had for a long time. Fifth issue, and this is central actually to the whole thing, but people rarely talk about it. To make this work in a digital world, it's absolutely crucial for financial inclusion and regulatory purposes to have a government-sponsored, decided digital identification. Because without that, if you can't explain in a digital form who you are, then you can't really run these systems, and you also need this when it comes to know your customer, anti-money laundering, and all the rest of it. And then the sixth issue, which is very, very basic, and Simon referred to it already, if the electricity goes out, you still need physical banknotes somewhere in the country, and you need to have a system to distribute them in case you have a problem of some sort. Where you hold the cash in between when people don't use cash, that's my job, and it's nobody else's business to understand where the money is at. They only need to understand that it's going to be available, and it's my job and to make sure that my staff will make that happen. So what does this mean? Well, essentially, my vision is listing the same responsibilities that we have today, but in an IT-based world which is quite different. But so in that sense, There's nothing new under the sun, despite the fact that technologies change. But everything I said is basically dealing with plumbing issues, but plumbing issues in real time. And that's different compared to what we've had in the past.
Thank you very much. That's very, very useful and very, very clear. So what's the perspective that you have, Simon, from on the policy issues that this emergence of new digital systems, particularly digital payment systems of enormous scale, what sort of issues does that create for the existing regulators, but the regulators and the challenges they're going to have to resolve?
So I think you heard today in Lael's speech, one of the concerns is the two-tier system we have is very good at doing things that central banks aren't good at. Who exactly should get credit? How do we follow that? How do we work out how to transfer risk, whether it be locally or across the globe? There's no reason banks, that the central bank should have any particular skill in that. I often say to people, I actually know of a central bank that used to do all of this. It was the People's Bank of China. And they decided in the late 70s that that wasn't the best use of the People's Bank of China, and it seems to have worked out well for them. They do have state-run banks, but they delegate to them a lot of how to extend credit, how to transfer risk. If you are going to keep a two-tier system and you issue a central bank digital currency, whether it's account-based or token-based, how do you control that from taking away the funding of the traditional system? You had one version of that. Let's just think of a version where of the 10 to 11 trillion of deposits in the US that might move, 5 trillion move. And the central bank needs to get 5 trillion on the asset side. Does it buy treasuries for that? If it buys treasuries for that, then the government's going to have to fund someone. If it loans to banks, then it's going to have to decide, is it happy with that? The other argument, and I think this is the most critical one, is it's unlikely that you would see that much transfer of deposits from the private sector to the public sector in normal times. We've had postal banks, Treasury Direct is there right now. You can go and just hold T-bills in a direct way. In a time when you're worried about banks, just at the wrong time, everyone would then take their money out and put it into the central bank because that's the individually efficient thing to do, and you shouldn't argue with that. So that would make dealing with runs much harder. How can you deal with this? If we're trying to deal with the retail payments, they're not that big. That was if your slide was there, you can't see them in the US one. So you can easily limit the size of the accounts, whether they be token-based or account-based. You can have a stable coin or outsource how those are run. The central bank doesn't have to do that, but the government does have to regulate them, and it needs to regulate them in some distinct ways. The first one is to make sure, and this is not a feature of the current system, that people who are underbanked or unbanked don't get ripped off as much as they do right now with the ATM fees and other things. That seems pretty easy, and it's low-hanging fruit in the US. Sweden doesn't have that. It's a much more efficient system. That seems like a pressing need to fix that in the near term. The other one is the data that is being used. It should be the case that the people who are going to use your data pay you for using that data. And the more that you can construct a system where there's some regulation around that, the better off you'll be. The one thing you probably want to make clear when you're doing this, and this goes back to my last point, is this is not an attempt to get deeply negative nominal rates. You're not trying to get to a point you can do that. That would destabilize the financial system in the transition.
Yes, it's your turn.
Just following up on Stefan's 6 points. I think his fifth one, which was on the importance of a system of digital ID, I think this is really, really crucial. I think I've described how in many countries, retail payments using technology is incredibly seamless and very easy, but cross-border payment still is the bottleneck. And I think this is where we have a lot more work to do. Partly, the impediments are technological. And this is where the limits of the account-based money come in. Because typically, if you try and make a cross-border payment using account-based money, you have to go through several intermediaries. And the reason is you need an intermediary where both the receiver and the sender have to have deposits so that you can transfer the deposits from the payer to the receiver. But more important are the know your customer checks, where they can be very onerous, they can be very time-consuming, and we come across these figures all the time. The World Bank has done a study where if you make a $200 payment, you're spending $14 just as a fee, typically. I think this is one area where, from a financial inclusion perspective, we really need to make progress. And I think having a digital ID system which allows the payment systems across countries to talk to each other is going to be a very, very important first step.
That's a global ID?
No, not a global ID, but at least having the opening up the possibility where where payment systems of two different jurisdictions can actually make the KYC process much more seamless. And I think if we can address this issue, many of the arguments one hears for why global stablecoins are going to be, are in fact necessary, are in fact going to improve customer experience, I think will be much less strong. But this is one area where we have to acknowledge as policymakers that the progress has been least satisfactory.
I'd add a couple of things to that, and where it gets hard when we talk about where to draw the line between the central bank and the private sector is we are so accustomed to having central banks. So what you really need to think through is what would the system look without a central bank completely? And that takes you back to the 1800s in the US, for example, and all the issues that people were through back in those days. And I'm not talking about using somebody else's currency, somebody else's central bank. I'm talking about the intellectual case when you think through no central bank at all, none, anywhere in the world, and what you get. And then usually people would come up with the conclusion that we need a central bank. So then you would reinvent the central bank.
Regulation, you definitely need it.
Yeah.
Sorry, what was that?
Regulation, you need it. That's in the 50s. They went to the 1850s. They went for more regulation.
One issue that
Without a central bank, you couldn't have our financial system. So you'd really be starting from scratch.
But let me add one issue that we're referring to Hyun's reflection when it comes to cross-border payments and why this is a relevant issue as of today. We're presently talking to the ECB about using their real-time low-value gross settlement system that runs 24/7 for euros. But starting in 2021, if we can come to an agreement with the ECB, we can use the system for Swedish kroner. And what that means that we have two currencies running real time. You probably don't have to be Einstein's brother to figure out how to do the switch. And given that we're actually talking about the same computer system and the same servers, and that means that if we can solve that in harmony within the central bank community, then I just can't see what the value added of Libra would be in that environment. But anyway, that's my view. It's a competitive business.
It's very important for you that this be closed soon, because we started very, very late. So I was proposing to allow them to talk a little bit longer. But if you want to close it, I will do so.
Sorry for the logistical interruption. Point one, if people are content to let the geniuses talk longer, I think you will get value out of it. I will put a hard deadline at 5:45 because we want people to have a chance to eat and drink. Second, I thank Martin for stepping in. I apologize for not having made the seamless transition to Martin. I was coughing and I didn't want to distract, so I stepped out. Third, whenever this is done, Marcus gets the last word.
Yeah.
Okay.
You have described perfectly how we intended to proceed, so it's what we're going to do. At this stage, I have many, many further questions, huge number, but in the next, say, 10, 15 minutes, well, let's have some questions, and then we'll allow Marcus. I'm going to allow each of them to have another 30 seconds or so to summarize the single most important thing you should take away from what they said, and then we'll have Marcus. So any questions? Please, the same rules apply. Say who you are and stand up. Then you will be, Patrick, you will be the next one.
Thank you. This has been a fantastic panel. Thank you very much. I've learned a lot. So I raised this question to, I'm Dong Hei from the IMF. I've asked this question to Marcus earlier at lunchtime. So I'm going to ask the same question to the other panelists. So in a way, I very much agree with Marcus that the unit of account is probably the most important function of money. And of course, that's what central banks care most about. So why do you think that Libra, as is proposed, has a different unit of account? Might have it been much easier if they had proposed a Libra that's pegged only to the US dollar? So what is the reason? So do we have to worry about that platform monies? Even if it's not a Libra, similar concepts might survive. Why do they have incentive to have a different unit of account? Thank you.
The way I'm going to do this, my normal way, you're not going to answer these questions. I'm going to take two or three, then I will decide which of them are going to be asked and in which order. This is not a democracy. Patrick, yes, please.
Patrick Honan, Peterson Institute. My question about Libra, really, and the excitement that this has generated. So why do we think Libra is, it could be big very quickly? It's because, I suppose, because they have a large number of affiliates at the moment, of members who trust the brand, and it's credible that this big company can work a credible payments technology. So that explains why they might get a huge portion of the retail payment system. But it's not clear to me why this should attract, in any short-term time scale, a large portion of the wholesale payment system, or any large scale at all of the store of value, why they should be able to compete with, BlackRock, Vanguard, et cetera, et cetera. Am I completely wrong about that? I'm not saying that in 50 years' time, they won't be all big tech companies, but this particular initiative seems smaller than the amount of reaction that we're getting about it.
Thank you.
Thank you. I'm with Bloomberg News. Can I ask for your broad take on China's push to create its own digital currency, the central bank digital currency? The design of it certainly differs a lot from what we talked about today, the digital currency for general purpose. What's your view on their approach, and what would be the implication on either Alipay or WeChat or other monetary authorities overseas trying to look at a similar topic? Thank you.
So there are two questions, and we can bring them together about Libra. What on earth were they thinking? I think is the first one, and why. I have a view, but I'm not a panelist. And surely there are inherent limits in what it can achieve, particularly out beyond the retail system, which I think is a very important point about these platforms. And in Facebook case, it's not a trusted transaction platform anyway. So it would seem to sort of make sense for Amazon, because it is a trusted transactions platform. My own humble view, and I'm on the record there, so anyone who trusts Facebook for anything is a deluded fool. But anyway, anyone wants to talk specifically about the Libra idea, because it's obviously a big issue. Hyun? Are you prepared to say something about it?
Well, to Patrick's question, I alluded earlier to the limits of a cash in advance system for wholesale payments. If you have to top up your wallet before you make the payment and you cannot be overdrawn, given the kind of sums we are talking about in the wholesale payment system, where you're actually paying the annual GDP in 1 week, it's not going to be a very efficient way to run the wholesale payment system. On the store of value, it's also very interesting just to look at the magnitudes for Alipay and WeChat Pay as well, because although they're very important players in the payment system, if you look at their balances, including the money market funds, if you add up the whole of the assets of the payment float together with the money market fund, we only get to about 2% of the total deposits in the banking system in China. So it is a very, very small part of the overall financial assets. So I think we have to keep these things in perspective. I think the interest that Libra has generated, I think it goes back to what I was referring to earlier, which is the idea that you can use the installed network base and then exploit that in the provision of payment services, and the possibility that you could get a walled garden, which is separate from the public backbone. And I think some of the background to the misgivings that some people have expressed.
Do you want to add anything on Libra?
So I think it's pretty obvious why they wanted a basket, given the 2.7 billion people are all located in this country. On the other hand, it'd be much easier to tell people it's backed by reserves held at the Federal Reserve. That would make everyone realize it was actually stable in value. It gets very hard to explain to people when it's a basket that it's stable, but you don't know whether it's really stable. People would do a lot of transactions in dollars. That shows you that the politics of this are quite difficult. Private actors aren't necessarily perfect at trying to deal with this. In terms of China, I don't know what the details are there. I will say that We Bank is an interesting entity there, where they use some of this data and they extend credit in a very quick way without ever having met people. They do use a lot of data to extend that credit, and it's not obvious in other countries we feel so happy with that. It's a very interesting way. And just to go back to my point, we shouldn't knock Facebook too much here. There could be tremendous value. It might not be measured in GDP, but there could be some value here of how to connect people that we are missing. And I think you were trying to indicate that in the paper you wrote, that these platforms have told us quite a bit about what people value. It might not be measured in GDP, but it could be something that has a lot of social value.
Just 2 points very quickly. I think this cross-border aspect of Libra is, if it works, the core unique selling point, and it's a big deal. And that comes out, you said, so because cross-border payments is an unspeakable mess, particularly for small transactors. The second point is I did see the PBOC at some length in March to talk about this, and they very much underlined what Hyun said, that really and truly, if you looked at what the big payment platforms do in monetary terms in China, and even in payments, because they're not doing all the corporate payments and all the rest of it, it's very much smaller than the numbers sometimes suggest. Finally, Stefan, do you have anything to say on the PBOC?
Well, it's too early to tell. I certainly don't know what they're going to come up with and what they're going to do. But there's one aspect to all of this, which is, again, repeating, there's nothing new under the sun. My understanding is that for these new systems, they're now imposing a 100% reserve requirement. And that's exactly the conversation that we had in the late 1800s in my country, when the banks were issuing physical money and the central bank was issuing physical central bank money. And then there was also a very harsh reserve requirement imposed on the banks, and that ensured that you had an exchange rate 1-to-1 between central bank money and private bank money. And without that, the system simply would not have worked. And this is why I think they have come up with this conclusion, and that's the way it's going to be run presently, because that's where you really have to decide whether you want to have a sort of a numeraire or an exchange rate which is easy to understand one-to-one in the system. And if that goes out the window, then everybody will revert back to central bank money in one form or the other.
I'm going to take one or possibly two questions if they're really quick. So this is your first. Please say who you are and very, very quick question.
Yan Qing from Yicai Media Group. Very quickly, if we think private invested or stable coin money like Libra is very dangerous, should we have a global central banking issued kind of from BIS issued a kind of ESDR? It will be safer, or will ESDR dominate the global monetary system if the SDR fail to do that? And very quickly for Ham, you have...
Sorry, we're going to have to be one question. I'm sorry, because I'm going to be killed if I let it go on. Jean, and that'll be the last one. I'm really sorry, but you can ask them privately after.
A very simple question. 60 years ago, American Express introduced a credit card. So it was substituting cash, it was substituting checks, it was a way to provide credit, and it provided massive information to the provider of the credit card, and nothing changed. So what is different this time?
Okay. Who wants to talk about central bank? No, sorry. An ESDR, could it do substantially better than the original SDR has in being a successful reserve asset, in this case turning presumably into successful money? Simon, you're shaking your head, so...
The dollar works really well, and the network effects are massive. You're not going to get people to coordinate in any real time on this. There are issues to how dominant the dollar is. That's why Governor Carney gave the speech he gave at Jackson Hole. But he kept on saying, you got to play the cards you have. And the notion that this is going to change over the next 5 years, it's not going to happen. The dollar is actually growing in importance. And the fact, we talked a lot about Facebook Libra. If you look over the last few weeks, I don't think people's view of the success of that has gone up. I think it's gone close to zero.
So Hyun and Stefan last, Jean is essentially asking the question, is it really different this time? And in fact, Marcus started this with his discussion of the e-money debate was, what, 20 years ago? I can't remember the exact figures. So we've had credit cards, we've had payment cards. It hasn't really changed anything. Are we getting much too excited about a change in technology when it really is not going to change the core architecture? Marcus is putting forward the argument, that his co-authors, that it really could change the core architecture. So from your perceptions, you two, what do you think, very quickly? Is it, how different is it this time?
I think the short answer is it remains to be seen. Because I think it's the only answer, because I think it's too early to tell. There is a lot of excitement about the technology. But take even the simple example of decentralized consensus and distributed ledger technology. That is so the technology and the cryptographic way of keeping track of who pays whom has been an advance, but it remains to be seen how widely that's going to be adopted and will make an impact. And the initial indications are that it is a very exciting idea. It goes back to some of the roots of monetary economics, that we have a huge ledger that says who pays whom, and we can keep tabs rather than having pieces of paper or gold coins. But, and there's no doubt that technology has enabled us to realize some of these theoretical ideas in practice. However, the returns that that we've seen so far have been rather meager. And we'll need to see how far the technology is going to drive the function. And I think this is, I would go back to my very first point. The technology is an enabler, it's not the end.
And very briefly,
if central banks adapt and start using new technologies themselves, then central banks will continue to be around for a long, long time to come. Had we stuck to 45-pound copper coins from the 1600s until today, we probably would not have existed.
That's a nice answer. So, Marcus, a few minutes of reaction to what you've heard, but really make it very brief.
Okay. Let me first thank all of you for a great panel, and also to the audience for being here till the end. Let me make a few comments which I collected as different views. I think one thing which is striking, that the age-old issues resurfaced, and I agree, and it's an exciting time that you can restudy essentially all monetary theory. But I think there is one difference, and Simon pointed to it as well. I think it's connection to platforms and the data connection. I think it's way more pronounced this time. And I think that's the new element combined with the token, which really makes this evolution, I think, different. It's also leading in terms of speed whenever there's a financial crisis to much, much faster development. The other difference I see is that the danger of dollarization or digital dollarization is probably much more pronounced compared to credit cards. I don't see that, a credit card is still in your national currency. I don't see that suddenly a foreign denominated credit card is taking over as a country. I don't think it's an issue for the US because the dollar is very dominant in all this, but for smaller countries, very open countries, that's, I think, a larger issue. With regard to retail transactions, I agree that retail is small, but it might be the most lucrative way. So the spreads, you can do on the retail side, you can probably make a lot of money, and that's probably what Facebook and others are looking at. Say, I can have a lot of deposits, and going back to the Starbucks example, they don't get any interest on this money they're lending to Starbucks. And that's very lucrative. And Facebook probably sees there will be perhaps $1 billion or some $1 billion you can borrow for free in a high interest rate environment, a high inflation environment. That's very, very lucrative. You won't get this from professional investors because a lot of these financial transactions might be algo trading to a large extent. All shows up in this wholesale transactions. So that's why I wouldn't downplay the retail side too much. I agree the financial inclusion is the big component. I think that's one. I don't see it with Libra suddenly doing a huge financial inclusion, but I think that should be the argument we should go forward. I see a big disagreement on the panel with regard to CBDC. I think Stefan is very in favor of it, and I think Sweden is going forward with that. Simon is very against it. Or
in small
perhaps
size, it's okay.
In small size, it's okay. So there is a big debate still ongoing. I don't think we have resolved that. And finally, I would like to come back what Martin mentioned in the beginning. It might be a better way, the whole evolution or revolution might actually lead to a much more efficient system, especially more financial inclusions. But we don't know yet how it will look like. But the transition is actually very difficult and very risky. And it might take a century and 2 financial crises and a Great Depression to get there. So it might be very risky. So coming back to Lael Brainard's presentation, why should the US do it? Why should we risk the whole global financial system with $1? Let's just do it with a small country. And I hope that Stefan is offering Sweden to to be the experimenter. And I think in return, we should offer some backup lender of last resort policy towards Sweden, because we all learn, the whole world will learn from the Swedish experiment, or perhaps Israel or some other country which is very much technologically driven, can move ahead. And I hope that for human beings or for the innovation itself, that some countries move ahead with some guarantees from other countries to do that. And we will see how these things will play out.
Okay, I'm going to conclude, but I'd just like to end up with, I think somebody mentioned Dornbusch's view on economic processes, and the crisis when it happens is quicker than you ever imagined. My memory now, I've forgotten this, about 20 years ago, and I think it was Bill Gates, but it might have been somebody else, made essentially the same point about technology. This was the beginning of the dot-com bubble and all the rest of it. And the argument was essentially fundamentally new technologies change the world much more slowly than most people originally expect. But in the end, they change it completely. And I have a pretty strong suspicion that in this case, though I wish it weren't the case, or in some ways I don't, that this is going to be an example.
Okay, for some reason that just cut off randomly. I guess they end the stream. Stream live 14 minutes ago. Hold on, because it wasn't over. I guess it was just over, but it was just getting near the end of it. I don't know if... I guess they just ended it right now. It's not letting me do anything. Okay, well, I guess that's the end of it. It might have been cut off a couple minutes early, probably because they just end their live stream from their feed, so... we might not get like the entire stream, but we pretty much got most of it. Again, I was a little bit delayed off because I wanted to stream the whole thing. So yeah, pretty much for people who want to know about the Ripple thing, I can't put a timestamp because it's not letting me because I'm streaming. But somebody from Twitter, Tom B, made a clip from the stream. So if people want to see the Ripple question, here you guys go. So just click on the Twitter link if you guys have Twitter, and the Ripple question should be right there. It's a link that Tom B made a little clip from this stream for people who are wondering about the Ripple question. So there you guys go. So that's just pretty much the whole thing. The Federal Reserve on the future of money in digital age, and also some other interesting speakers as well. I don't know. I think overall it was a good thing to just watch. Overall, I mean, they were pretty much talking about payments and just advancing and just seeing how it's gonna go forward in our future. So I think that's pretty much it. Your voice is changing. You're growing up. Tinder. I can't do it on Tinder, but yeah, if you guys have Twitter, Tom B made a little short clip from it, I think, and it asks the Ripple question. So. But yeah, thanks for the stream. Yeah, I appreciate you guys. Thank you, everybody. Thank you for donated. I'm gonna shout out to all the people that donated and to the people in the stream, and now I'm gonna end it right there. So thank you so much, Gavin Tuska, and thank you, Rob Cash. I appreciate that so much, man. Thank you, XRP Superman Punch. Thank you, 5894 Sure. Thank you, Bones. I appreciate that, man. Thank you, Joe. Thank you, Crypto Bug again. Thank you, Joe, and then thank you, Crypto Bug again. So I appreciate every single one of you guys. I appreciate all the likes, dislikes, watches, like nearly 300 people in the stream, which is over 300 people in the stream. But yeah, so yeah, that is it for this stream. Again, I will see you guys in the next one. Hope you guys have a good day, and peace.